when you look towards the inflationary recessions of the past, let's say you look back to the 70s, you look at, call it 69 to 73, and then you look at 78 to 80, payroll employment is the last indicator to turn in an inflationary recession. And so I think that number one, the data's lagged by at least 6 months, right? And I think that this expansion in payrolls, again, will be the last thing to turn. Unfortunately, Chairman Powell is focused on payroll employment, i.e.,
right,
that's his barometer. He's focusing on the wrong barometer for this type of economic scenario. Now, he's not an economist by trade, but he's incredibly smart. And let's hope that he's listening to some of his external advisors who know this.
Right. And the 1,000+ PhDs that work at the Fed, right?
Yeah. So I think they're focused on the wrong indicator as their barometer. And maybe it's purposeful, maybe it's not, but the payrolls numbers will turn. Typically, the payrolls numbers turn 5 to 10 months into a recession. So it is way behind, and it will turn.
Okay, so you are expecting that turn just on the delay. All right, so I actually want to talk about delays in terms of Fed policy, but just building on what you just said there. So the Fed right now is, if I heard you correctly, I think you said you expect them to continue hiking for the foreseeable future, at least, and I think we want to assume they know they got themselves into a bit of a corner, not even a bit, a big corner. We're blowing, the everything bubble, or at least getting asset prices to probably long-term unsustainable highs and having interest rates at rock bottom lows, where when the next economic downturn came along, they had no room to drop rates because they were at zero. Now their inflation to a certain extent is giving them the excuse to raise rates. Now, of course, they have to raise rates to fight it. So it's not like it's a happy situation for them. But when you look at what the Fed is sort of looking at its main dashboard, it's saying, okay, inflation's still hot, right? 8.5%, 40+ year high. We got to raise rates to do that. Okay, unemployment still near record lows. Okay, we're good there, right? So we can continue to raise rates. And what's the market doing? Oh, well, yeah, it came down this year, but it's actually been in rally mode for the most part over the past month. So we're not breaking the market. So looking at kind of all three of those indicators, those seem to give the Fed a lot of blue sky ahead of it to continue raising rates. So is that largely sort of why you consider that they're going to keep raising from here while they can?
Yeah, I mean, the headline numbers are pushing them to raise rates. But I think that you've got a scenario where there's 40% more M2 in the system since COVID began, right?
Yeah.
And you've got a scenario where that money is still in the system. If you look at the mortgage, the way the mortgages roll off on the Fed balance sheet, the Fed is just now starting to reduce its balance sheet, literally as we speak here in August. And so, that raising rates into an environment where you've put 40% more money in the system is like pushing on a string. What you've got to do is take the money out of the system, and they've just begun to do so. So if you look back to December of 2018, that was the last time they were aggressively removing money from the system and raising rates, and the market dropped 20% in a month, 22% in a month, right?
Mm-hmm.
So now that they're going to start removing 60 to 95 billion a month of risk capital from the market. I think now is where the rubber meets the road. So if you're asking, is now the time to invest? I don't think now's the time to invest. I think you need 3 to 6 months of them pulling 60 to 95 billion of risk capital out and raising rates to really try to understand where the market bottom is. And I'm not trying to pick a bottom. I'm just saying that all of the factors that are at play today are money is about to start draining, and they're continuing to raise rates. Whatever Powell says at Jackson Hole, whether it's 50 or 75, I think he's backed into a corner, as you just said, Adam. So now's not the time to be aggressive, in my opinion.
All right, Kyle. Well, look, I got a lot of questions about capital allocation that we'll get to in a bit here. Just in recapping, it sounds like you think that the direction for markets is more likely to be down from here, given what you just mentioned, that we're going to start draining some of that excess, money sloshing around from the pond here, while the Fed continues to hike rates, and that's going to slow the economy even further, bring asset prices down. So a question around that, and I'm curious to hear your thoughts on this because I've discussed this with several recent experts on this program. Historically, there's a bit of a lag when the Fed, pulls a lever and when the impact of that lever is fully felt in the economy. And historically, I've heard numbers tossed out, 9-ish months or something like that, but measured in a couple of quarters usually. So let's say you're correct, where in a couple of months of QT going on and really beginning to drain water out of the bathtub, the markets really begin to kind of nose over again, and everybody realizes we're in a recession now. We're not quibbling. Quibbling. What's the word? Quibbling. Thank you. Quibbling over the definition of a recession. We just all know it doesn't feel good, right? Now, the Fed just started its rate hikes in February, and the pace of rate hikes that we've gone through is the fastest ever on record, right? And so could we be in a position where we hit this recession, market correction, and yet we still have this backlog of shockwaves from the previous rate hikes that have been done over the past, 8 months or 9 months by that time, that just keep slamming into the system month after month after month. In other words, we engineer a recession, but then it actually gets made a lot worse, not by the tightening the Fed continues to do, but by the tightening the Fed has already done.
Yeah, I actually think that the tightening, when you look back to Bernanke's helicopter speech, I've probably read that speech 15 times. It's worth a reread. He talks about the zero lower bound almost as a tractor beam. He says you should avoid it at all costs in this speech. He says, but if you ever have to approach the zero lower bound on rates, you need to get away from it as quickly as possible before expectations get set at those new levels. We're at the zero lower bound for the better part of a decade, Adam. So
right, that's investors' normal now, right?
Right. And so when you think mortgage rates, normal's 3.5%. Normal's not 6. And you get mortgages from 3.5 to 6, and you're going to have the economy turn off. And to your point, I actually think that's where they're going to take us. Meaning they're going to take short rates to 3.50. I actually didn't think they'd get them to 3. It's all about the delta from the bottom. It's not about the nominal number. And the delta from the bottom is almost infinite when you start at 0, right? So,
right.
But when you move 300 basis points after you've been at 0 for almost a decade, all economic activity will turn off. So you look at the auto loan data. The auto loan data is absolutely abysmal right now. The housing data is horrible, and it's just taking time to catch up. The Manheim Index of used vehicle prices, started, let's say in 2008, the average for the year was 106. For 2021, the average was 199. In 2022, it's January 2022 started, the Manheim Index started at 236. It's already dropped to 211. It's dropped 10% in 8 months. And it's headed lower. It's headed lower fast. So I think you're seeing the number of auto loans where a lot of the LTVs got to be 150%. The auto lenders are going to be in real trouble. The housing lenders are going to be in trouble. You already see mortgage lenders going broke. And you're going to see housing come to a grinding halt. Now, I don't think housing prices are going to drop like they dropped in 2008 and 9. I think you're going to see housing prices drop 10, 12% over this move. And I don't think the Fed will be able to pull more than $1 trillion off their balance sheet before they have to stop. So I think we have a permanent $7 trillion Fed balance sheet. But to your point, you're 6 to 8 months into pulling $100 billion a month out, and you're going to realize that you made an error.
Yeah,
but they're going to make that error.
Yeah, look, I trust your expertise on this a lot more than mine, but I definitely agree with you here. So, so it sounds like you think we're going to experience, a recession, and probably not a shallow one that's probably going to hurt for a while, hurt and probably last for a while. Is that true?
The last for a while, I'm not sure, Adam. I think it's going to be so sharp and so evident when the numbers actually start printing that they're going to have to immediately pause and immediately have to turn and start talking cutting, because the severity of the recession is going to be mind-boggling in the numbers. And if you think about this, if you and I printed 40% more money 2.5 years ago, and let's just assume we move the price level from 100 to 140, for us to generate a 135 print would be pretty easy, right? Mm-hmm. If you just tighten things up really quick. If you tighten things up too hard, too fast, you could get a print that's a 120. And the year over year, month over month, quarter over quarter numbers are going to scare the hell out of the Fed, right? If you follow me. So I think that's what we're going to see.
If you enjoyed this video clip, click here to watch another one you should like.